today's proceedings. Today our panel is led by our Governor, Lesetja Kganyago, and he's accompanied by his deputy governors as well as colleagues from the Financial Stability Department. Today, the SARB is releasing, and when I say SARB, it's the South African Reserve Bank. I know that acronym sometimes confuses, but the South African Reserve Bank is releasing its first edition of the 2025 Financial Stability Review. And this is part of the South African Reserve Bank's mandate to protect and enhance financial stability in South Africa. And in fulfilling this mandate, the South African Reserve Bank conducts and communicates an assessment of the financial stability of the domestic financial system. So what you'll find in the Financial Stability Review of today is an assessment of financial stability over the past 6 months. Also what you'll see is an assessment of risks and vulnerabilities to the financial system for the next 12 months. What we also communicate in today's FSR that we are releasing is an overview of policy actions and any mitigants that have been undertaken over the period under review. And our program will be led today with the Governor's opening remarks. Thereafter, Dr. Nicola Brink, who is the head of the Financial Stability Department, will give a synopsis of the Financial Stability Review that we are releasing today. And as per the norm, a Q&A session will be afforded to those that are in the room as well as those that are online. Also, towards the end, as you walk out, for those that are here in person, there is a copy of our Financial Stability Review. And also, if you don't mind sharing with your colleagues that may not have made it today, they can also download it via the online or via the website. So, Governor, over to you for opening remarks. Thank you.
Thank you very much, Eddie, and good afternoon, everyone. Thanks for joining us in this forum, and welcome to the first 2025 Financial Stability Forum, where we release the Financial Stability Review and publish our assessment of financial stability in the country. A lot happened since the release of our previous FSR, published in November last year. The Financial Stability Review is a document mandated by the Financial Sector Regulations Act, which requires the South African Reserve Bank to assess and communicate the stability of the South African financial system. We do this twice a year. Globally, we are witnessing a significant disruption of the international trade system. We are also seeing intensifying global conflicts, with the war in Ukraine ongoing and conflict escalating in the Middle East. So far, South Africa's financial system is demonstrating a high degree of resilience in response to these and other global shocks. Nonetheless, there are risks which we discuss in the Financial Stability Review. We also identify certain ongoing structural risks, such as South Africa's low and inequitable economic growth, the implications of climate change for the financial sector, and the ever-present risk of cyber attacks disrupting the financial system. We also discuss new work on some of the tools and measures we use to study and protect financial stability. These include a revised methodology for calculating the credit to GDP gap, which is an important measure of identifying excess credit growth. It should be noted that we don't see an overheating of credit currently. However, our ability to monitor it is now further advanced. We also showcase a new and improved Financial Conditions Index, which was first published in the November 2024 FSR and complements the credit to GDP gap. It also forms part of the suite of macroprudential indicators the South African Reserve Bank uses to monitor financial stability conditions. We have also been working on adjusting the counter-cyclical capital buffer to a neutral level of 1%, which would give us space to adjust it both down and up as the cycle requires. The first FSR references a series of studies we have done on this particular subject using econometric models. Relevant papers on this topic have been published on our website. Broadly, this research suggests the move up to 1% will have a modest and temporary impact on credit extension. This is low cost relative to the longer run benefits. Finally, climate change will be an abiding challenge with which impacts that include risks to financial stability. Last year, we conducted a first climate risk stress test to evaluate the resilience of systemically important banks to climate-related shocks. The FSR provides an overview of the lessons learned from the test. We have also published a standalone technical report on climate risk stress test on our website. Before I conclude, I would like to mention the SARB's Financial Stability Research Symposium, which takes place next week. The symposium is based on our financial stability research agenda, which supports practical, evidence-based macroprudential policy making. The theme for this year is maintaining financial stability amid global volatility and uncertainty. Just like the many conferences we had been attending around the world, every conference that we attend has got the word uncertainty in them. Whether it's about monetary policy or about growth prospects, it has got the word uncertainty in it, which then says to us, the one thing that is certain is that uncertainty is here with us. In closing, let me thank you for joining us today, and I would like to hand over to Dr. Brink, who will take you through the key areas of the review. But before that, DG Chatsivana, I know you were dealing with non-financial stability issues. Can you come and occupy your place? Because we're going to direct the most difficult questions to the CEO of the Prudential Authority, and they better see you here. Nicola?
Good afternoon, and thank you, Governor, for the opportunity to present our assessment of financial stability in South Africa. The contents of my presentation is really quite simple. I'll do a brief introduction of why and how the Reserve Bank assesses financial stability, then look at the key risks and vulnerabilities, the policy actions and initiatives that are undertaken to mitigate risks, and I'll end off with a brief financial stability assessment. Starting with the why, and the Governor has alluded to it, so I'm not going to repeat a lot. We get the mandate from the Financial Sector Regulation Act. We take our guidance from the definition of financial stability, which is the ability of financial institutions generally to provide and to continue to provide products and services, and generally to perform their functions and duties in terms of financial sector laws. Importantly also, the Act requires that they should be able to continue performing irrespective of economic developments and also in strained circumstances, and that the public must have confidence in the financial sector to continue doing so. So we report on financial stability developments twice a year as required by the Act. Our review period stretches from November last year. Our forward-looking period is at least 12 months. It's not necessarily, it doesn't end at 12 months, but it's at least 12 months. Then looking at the how, and for me to talk about the how, I would like to classify systemic risk into its two broad categories. The one is a class of risks, or what is referred to generally as cyclical risks. And those are imbalances that build up within the financial system over time. Things like asset price bubbles, excessive credit growth, high volatility, or liquidity pressures. Cyclical risks you can monitor through quantitative indicators, and we do have a wide set of quantitative financial stability indicators. There's an annexure at the end of the FSR showing some of them. And if these imbalances really become big, you can apply macroprudential policy tools to mitigate them before they become unsustainable. By contrast, structural risks arise from the environment in which financial institutions operate. And that includes the economic, the political, the technological, and the physical environment. There are typically both direct and indirect spillovers on the financial sector. Mostly, it is not under the control of the central bank or any single authority to mitigate these structural impediments. It requires collaboration and structural intervention, and there's most likely going to be some residual risk, and for that we conduct crisis preparedness, and I've got something about that in the presentation as well. So financial stability is assessed by the Reserve Bank's Financial Stability Committee, which meets 6 times a year to consider both, in the morning typically, the risks and the macro developments, and in the afternoons, any policy decisions. Some of the risks to financial stability originate outside our borders, and therefore we commence our assessment with global developments. During the review period, the global financial system experienced a degree of uncertainty and volatility that is similar to, and in some respects worse than what it was at the onset of the COVID pandemic. Indicators of both trade and economic policy uncertainty, those are the red and purple lines, shot up sharply, and geopolitical risk, the blue line, also remained elevated. The main causes for this uncertainty is well known. Firstly, the US tariffs that were announced and later on changed repeatedly. And then also the increase in the scale and scope of physical conflicts in Ukraine, the Middle East, and elsewhere. So why do we care about this uncertainty? Policy uncertainty and surprises typically cause volatility in financial markets, and that may have repercussions for the financial system. For example, through the exchange rate, lower growth prospects, losses on financial assets, higher inflation, increased risk aversion by foreign investors, and generally higher risk premia and funding costs. So before I present the heat map, please don't try to read anything on the left. It's all in the FSR, and you will just miss the message if you try to do that. The financial stability heat map provides a snapshot of the financial stability indicators of cyclical risk. And it's all relative to the long-term historical averages. So it's really a backward-looking tool, and its purpose is to prompt analysis into the areas where a potential buildup of imbalances is indicated. So red is bad and green is good. If something becomes red, it means that it's become very concerning relative to the long-term average. So what I just want to lift out here is that our qualitative analyses are supported by the quantitative indicators. The areas that kind of stood out as indicating potential imbalance is market volatility, the high sovereign exposures of our financial system, or financial institutions rather, household finances that experience stress, fiscal metrics, and capital flows. And I'll delve into these later in the presentation. The Financial Conditions Index provides a summary view of the ease with which South African households, corporates, and governments can fund themselves in the domestic financial markets. Financial conditions have loosened somewhat during the first half of the year, and this is mainly on the back of an increase in credit to corporates, but overall they remain tight. The main factors that contributed to tight financial conditions during the review period were the volatility in equity markets, weak household credit growth, and higher longer-term yields. So the breakdown of the FCI in its components is available in the FSR itself, and on our website there's also a paper underpinning the FSR that explains the composition in more detail. The credit to GDP gap is an indicator that the Reserve Bank uses to detect early signs of a buildup of excessive credit. If credit consistently grows faster than the real economy, it can lead to various risks for financial stability, such as over-indebtedness, defaults, and asset price bubbles that may be supported or fueled by high degrees of leverage. And we've seen in previous crises how this could end. South Africa's credit to GDP gap has been negative for a couple of years if one ignores this spike during COVID, which was really just a GDP-driven thing. And this indicates that excessive credit growth has not been a source of financial stability risk. The calculation of the GDP gap, credit to GDP gap, has been reviewed and refined by a research team, and a paper on the methodology is also available on the website. After considering all the information about cyclical and structural risks to financial stability, the Financial Stability Committee agrees on what the main risks are for the forecast period. The Residual Vulnerability Matrix, or RVM, depicts a forward-looking assessment of the vulnerability of the financial system to each of these key risks, after taking into account the impact of mitigating factors. So just a reminder, the further away from the center, the worse or the more vulnerable the sector is to a risk. Except for some rewording, no new risks have been added to the RVM since November. But the FSC has updated its assessment of the residual vulnerabilities. The main change in this edition of the FSR is that it now seems quite likely that South Africa will be removed from the FATF grey list in October 2025. Once this happens, of course, it will disappear from the RVM. The other vulnerabilities that have either remained the same or increased slightly include the risk of increased geopolitical tension and policy uncertainty, deteriorating public sector debt ratios, critical infrastructure failure, rapid capital outflows amid market uncertainty, and increased financial distress in households and small and medium enterprises. The FSC also confirmed the 3 perpetual risks that define the environment in which the financial sector operates, namely the long-term impact of climate change, the ever-present risk of a cyber event with systemic impact, and South Africa's chronic, low and inequitable economic growth. I'll discuss some extracts from the FSR in the subsequent slides, but of course for the full detail you'll have to refer to the publication itself. So this is really rare, but we have got potentially good news in this round of the FSR. Starting with the good news then, when South Africa was grey-listed by the FATF in February of 2023, an action plan was agreed with 22 action items that had to be addressed. After its recent plenary meeting held in Strasbourg on 12 and 13 June, the Financial Action Task Force, or the FATF, announced that South Africa has addressed or largely addressed all of these action items. The next step is that the FATF Africa Joint Group will now conduct an on-site visit, and this will happen before the next plenary meeting. The purpose is to confirm that the necessary reforms have taken place, that it will be sustained, and that it does enjoy the necessary political commitment. If confirmed, the FATF is expected to remove South Africa from the grey list at its October 2025 meeting, and this would mean that South Africa would have managed to be removed from the grey list in only 2.5 years, and it speaks to the commendable combined efforts of government, regulators, and the private sector to address the findings. I've already talked about the impact of trade and physical conflicts on global financial markets. Specifically relevant to South Africa, we must acknowledge that there's a good chance that the US-Africa Growth and Opportunity Act, or AGOA, will not be renewed later in the year. The likely impact of this has been modeled and communicated in the most recent monetary policy review, for those interested. Combined with the 30% tariffs imposed by the US on selected South African exports, the likely impact on the financial system would be through lower growth and, of course, the financial distress in most affected economic sectors, amongst others. And global uncertainty typically leads to a flight to safety, and this is evidenced currently by the very high gold price. And generally, uncertainty is also associated with capital outflows from emerging markets. Previous editions of the FSR have elaborated on the impact of a deterioration in critical infrastructure, such as roads, railways, water, and electricity on the financial system. There are no short-term remedies for these, but initiatives like Operation Volendlela and a review of the municipal funding model are promising longer-term mitigants. The figure on the left shows, just as an example, how Transnet tonnages have decreased from about 226 million tons in 2017 to a low of 150 million in 2022, just recovering slightly in later years. The government roadmap for allowing private train operating companies to access the national rail network should provide support for the growth targets of 2025 and 2026. And then on the right, after a reprieve in the latter half of last year, moderate levels of load shedding resumed in the first few months of the year. However, they have not been as severe as in the past, and the availability of renewable energy generation continues to grow. The Financial Sector Contingency Forum, or FSCF, which is chaired by the Reserve Bank with membership across the financial sector, continued with the implementation of a project to connect key nodes in the financial system, and that's basically in the payment, clearing, and settlement system, through alternate connectivity lines, and this is to be able to continue providing critical financial services in the event of a prolonged loss of connectivity for whichever reason. South Africa has recorded 2 consecutive primary budget surpluses over the past 2 fiscal years. However, the latest budget review projects South Africa's debt to GDP ratio to peak at 77.4%, and this is higher than the peak of 70.5% that was projected at the time of the medium-term budget policy statement. And the borrowing requirement and debt services cost are also projected to remain high. The financial sector has a significant exposure to government bonds, making it vulnerable potentially to valuation changes in the event of a shock to bond yields. As a mitigant, the Prudential Authority surveys the mark-to-market and hedging activities and practices of banks to detect early enough an excessive build-up of unrealized losses on individual banks' balance sheets. Bank data on non-performing loans continue to indicate financial strain, in particular among households and small and medium enterprises. For all categories of loans, the ratio of non-performing loans to total loans, or the purple lines, are above their long-term trends. The long-term trend is the horizontal dotted lines. However, as you can see on the green lines, the growth in non-performing loans seem to be subsiding, and lower interest rates should also provide some relief. An important mitigating factor insofar as the safety of banks is concerned is that banks make prudent provisions against non-performing loans as they occur. This edition of the FSR contains a write-up about the SARB's monitoring framework for assessing climate-related risks to financial stability. Among other trends, it highlights the issue of the climate insurance protection gap, which is the uninsured portion of economic losses that arise from climate-related shocks. Related to this is the growing list of uninsurable risks. Those are the risks that insurance companies explicitly exclude from their cover. The Reserve Bank conducted its first ever climate-related stress test on the 6 systemically important banks, and the scenarios and the results of this groundbreaking exercise are summarized in the FSR. The technical detail is available in a paper published on our website. In this respect, given the very long timeline of the scenarios up to 2050, the benefit of the exercise was not only in the results for each bank, but also in the insights gained about the divergent ability of banks to assess climate risk, the data gaps that have to be closed, which are quite different across the industry, and the contribution that this exercise will make towards a climate risk assessment maturity. This brings me to the policy actions. The phasing in of a 1% positive cycle neutral CCB is continuing and should be done by the end of the year. One of the questions we had in the media briefing is, what does this mean to the average South African? And I don't blame the asker for that. So if I could just explain it in very layman terms, the Reserve Bank is requiring banks, all banks, to hold 1 percentage point more capital that is there as a kind of a safety cushion, so that if there's a really severe stress like we had with COVID in the financial system, it does provide that leeway so that you can release it. Up to now, that capital buffer was at 0%. You can't make it negative, so we didn't have any room to provide relief from a macroprudential perspective, but with a 1% you can then lower it, and then when things have normalized, you build it up again to 1%. There's also the possibility to increase it, but that would be in a situation of overheating credit markets and so on, and we haven't seen that as you've seen. I've referred to the Prudential Authority's biannual survey of banks' valuation and hedging patterns for government bonds. This helps us to keep a track of trends in this area. The alternative connectivity project of the FSCF is continuing, and that is to increase resilience to operational disruptions in the financial industry. And then maybe to stop a moment at 2 simulation exercises that were conducted during the period under review. In the first one, and that was under the auspices of the FSCF, market participants tested their ability to close and reopen financial markets in an orderly way. So this would be a really unexpected closure, maybe a big cyber attack, or connectivity is lost, or when we started with this, there was the risk of a blackout scenario. But anything that would need an unexpected and prolonged closure of financial markets will trigger the what is called the orderly closing and opening of markets process. And what this is about is that it's quite important for everybody to close at the same point in the payment, clearing and settlement cycle, so that when you reopen, you all open from the same point. Otherwise, you've got floating transactions, halfway transactions, and counterparties will never be able to match their books upon opening. So this was going through the playbook. The whole financial industry participated. It was really a big exercise. And then the second simulation was between the Reserve Bank, which is now the Resolution Authority, and the Corporation for Deposit Insurance, or CODI, who jointly tested their ability to resolve a fictitious, medium-sized, failing bank using the new resolution framework and the new resolution tools. And then to end, there was also a cyber resilience exercise for industry professionals to respond to a real-world cyber threat in a controlled environment. That brings me to the end, which is our very straightforward assessment. The Reserve Bank assesses the financial stability to have been resilient since the previous assessment in November. And resilience is expected to be sustained over the forecast period to June 2026. Thank you. That's the end of my presentation, and Governor, I hand back to you.
Thank you very much, Nicola. At this stage, I open the floor for questions and comments. You can also compliment Nicola for a brilliant presentation. Mr. Masia, Professor Rousseau, Ms. Joffe, and Azajamin.
Thank you, Dr. Brink. Yes, I was going to thank her anyway, Governor, so thank you for that presentation. On the countercyclical capital buffer, I recall that this was actually introduced sometime early last year. Wasn't that the case, or is this a new intervention? And if it is, or perhaps either way, can you just let us know, have banks already started transitioning to this 1% level? So, what kind of number are we coming from? And then secondly, your enhanced financial conditions index. How does that differ from the previous version? In other words, what is it telling you? Are we more or less tight than what you previously thought was the case? Thank you.
Professor Rousseau.
Thank you, Governor. I was recently asked a question that I really couldn't answer about the thickness of R1 coins. So I said there can't be a problem with thickness with R1, and then I received some samples. So I have them here. Apparently the new R1 coins, some of them are too thick and do not fit into the slots of slot machines, and gives problems at places like garages after hours and whatever. And I really have the examples here, and they are thicker than the other R1 coins. So what is the position, and what should I answer when I get the question again? Thank you, Governor.
Hilary, are you going to respond to Yanni?
I haven't tried any slot machines lately. Hilary Jaffe from Business Day. Governor, you've been flagging for a while this issue of the high exposure of the banks to sovereign risk because of their significant, the rise in their ownership of bonds. And I imagine that there are concerns about the financial sector owning too much more of sovereign bonds, and particularly shorter term sovereign bonds, given the sort of refinancing risk. Now, I'm setting that against your paper on the inflation target, which estimated that government could save a very significant amount, up to 900 million, on its borrowing costs, with a lower inflation target and much more short-term borrowing by the government to take advantage of that. So what I'm wondering, Governor, is there a bit of a tension between your sort of what you want to do with monetary policy and what you want to do with financial stability in terms of discouraging the banks, say, on the one hand, to hold more short-term government paper, but hoping, on the other hand, that it will be an incentive for government to support your lower target if they can sort of issue more of that short-term paper?
Azar?
Governor, slightly related to this, but from a completely different angle. We know that our economy is underperforming, and arguably one of the causes of that underperformance is the lack of resilience of the economy of small business, who keep complaining about having insufficient access to finance, and the argument that the big players only like lending to big players and not to small businesses. And in many, a reflection of this was also the COVID crisis and the big loan agreement that was reached. I think it was 200 billion rand to help small businesses, and only 16 billion was actually issued. Is there a problem in terms of the, as much as we laud the concentration, the stability of our financial sector, is there not a problem in the sense that the regulations and rules for lending are circumscribed and not sufficiently resilient to take account of more than just regular salaries being paid into accounts and income coming into accounts, and need to look at a broader picture? Secondly, related to that, you're complaining about the exposure to sovereign, to the sovereign bonds, too much exposure. That in turn is a function of the steepness of our yield curve, which makes it attractive for banks to basically put their money more and more into investing in bonds rather than issuing the credit to the man in the street and small businesses and that kind of thing, and could be at the heart of the economic problems that the country faces. This is not a criticism of the Reserve Bank. In a way, it's a criticism of fiscal policy being too expansionary, which contributes towards this steepness of the yield curve. But I'd very much like your comments on that.
Thank you, Azar. In a way, you provided the answer, so I will have to supplement to you, to your answer, rather than give a different perspective. Let me see who gives me a get out of jail card. Andrea, the counter-cyclical capital buffer is not new. It's been there. There were times when we had kept it at 0, because we can't take it below 0. And it just reflected the state of the credit conditions. There was no need to impose it as the economy evolved, because there wasn't a lot of credit was growing, but it was really growing slightly above inflation, sometimes even below inflation. So there was no risk to financial stability emanating from expansive credit. But the best time to have this is whilst institutions are well capitalized, they are strong, and which is why we said, okay, they had been profitable, they'd come out of various shocks from COVID and so forth, and we can reinstate a counter-cyclical capital buffer. Your FCI question, initially I thought I understood it, but then I realized I didn't understand it, because I was going to say to you that if you look at the curve, you will see that it was tight, and then it loosened, and it was coming closer to neutral, which means that it was less restrictive. But another voice said to me, no, what he is actually asking is, you calculated it one way in the past, and it would have showed tightness or looseness. You are now calculating it differently. What is the difference? I will have to defer to higher office on that. Nicola will deal with that, and if you are still not happy, she can delegate it to even higher office to deal with that. And then, DG Chastivana, I want you to deal with the issue of access to finance by SMEs and whether regulations constrain them having access to that thing. Hillary, you raised an important point about the sovereign banking nexus, which in a way also links to what Azar was saying. And a little bit of history might be useful. When Basel III regulations were introduced, one of the ratios that was important was the liquidity coverage ratio. And in 2010-11, when we were looking at Basel III, there wasn't sufficient paper, government paper in South Africa for the banks to meet the liquidity coverage ratio. And we were not alone. Australia faced it, and so forth. The only countries that could meet the liquidity coverage ratios were those who were not fiscally rectitude. So if you would look at South Africa's fiscal accounts around 2008, 9, 10, 11, debt to GDP ratio was contained. It was below 50% actually in 2011. And as a result, there wasn't sufficient high-quality liquid assets for the banks to meet their liquidity coverage ratio. There was a gap, actually, of about 40%. And one of the thoughts was whether we say they can hold foreign paper. The problem, if you said they had foreign paper, then they introduce foreign exchange risk. And so that was not the route to go. And what we then did from the Reserve Bank's side was to then say that we can live with that gap, and we will put measures to help the banks to meet the gap. Well, from 2012 going forward, we ran expansive deficits. And those expansive deficits had to be funded. More paper was issued, which meant that banks were able to get the paper, and they were able to fill that liquidity coverage ratio. As you got into the zero lower bound in the advanced economies and the advanced economies, central banks were purchasing government bonds. Clearly that led to a decline in yields, and it led to an increase in bond prices, which also meant that the holdings of the banks were more valuable, so they could actually offload some of those bonds. What did we see in South Africa? Because as we were getting through, government deficits were also rising, but the investment environment was also not particularly welcoming. And so it was becoming attractive for the banks to hold the paper. And then, of course, we got downgraded. And as we got downgraded and foreigners were offloading our paper, someone else had to buy, and the banks and the other investors in the South African domestic market stepped in and bought the bonds. Entered COVID. Markets were in a gridlock. Nobody was borrowing. Even if you were a business, think of it. If you were a hotel, even if the banks offered you the credit and you go to say, okay, we can give you R1 billion. What were you going to do with it? Because there were no people coming to your hotel. I could have made it worse and said that if you were a boutique hotel in the Cape Winelands, where you relied on people coming to taste wine and sleep over, people were not allowed to drink wine and they couldn't sleep over. So even if you borrowed the money, you couldn't do the business. So the banks had to be looking elsewhere. And there wasn't a shortage of supply for the banks from two sources. Firstly, because of the economic shock, the government ran bigger deficits and thus issued more paper. And thus the banks became almost the buyers of last resort. And secondly, we finally lost the last investment grade we had, and so we then had all the foreigners running for the hills, and the banks stepped in. So basically, it was easy for the banks. You take the deposits, interest rates were very low. You take the deposits, you buy the government bonds in double digits, 13, 14% about at that time, and you just sit and enjoy the return. So no money is flowing to the real economy. As the economy reopened and economic activity returned, banks had to start lending. And of course, they will go and prioritize the premium borrowers. And so you will see that even as credit was recovering, it was going to the big corporates and not to the small to medium-sized enterprises. And Fundi will deal with that. And in a way, Azar, you say that the steepness of the yield curve is because of government deficits. That's, of course, important. And in there was the thing. Think of the bond yield, that it has got three important components. It has got an inflation component. It has got a term premium component. So longer dated bonds, investors will demand higher compensation. And lastly, a country risk premium component, which is very much driven by fiscal. And as our credit standing deteriorated, our yield curve didn't just become steeper, it also rose. It went up across the yield curve. And the concerns that we had, firstly from an economic perspective, not so much about the steepness of the yield curve, but about the huge bond holdings by the banks mainly, and to some extent you could say that the other investors would hold and it's okay, was that money is not flowing to real activity. And actually, at one stage in 2020, 2021, government's deficit was more than the savings rate of the country. So basically, government borrowed the entire savings of the nation. And so it goes without saying then that to release the resources to the other sectors of the economy, you have got to bring down government deficits and bring down government borrowing. So spot on that. Our concern about the bank sovereign nexus is not so much that the sovereign will default. So it has got nothing to do with the credit risk of government. but has to do with the mark-to-market risk that the banks carry. That when the yields move, because these bonds were issued at particular yields and particular coupons, if the bond yields rise and the banks have to reprice the bonds, they are going to have to take a knock to some extent on their profits and thus and possibly on capital. And if anything, in South Africa, the regulations spell that you must mark your bond portfolio to market. What led to the problems of Silicon Valley Bank in the US was precisely because the US carved out banks of a particular size and said they can account on a book value basis held to maturity rather than on a mark-to-market basis. But that you are saying you are holding the bonds to maturity, that's fine if you can hold the bond to maturity. 10 years, 15 years, 30 years, that's fine if you can hold it. But should you require liquidity and you have to liquidate your bond portfolio, you are going to liquidate it at a loss. And that is exactly what Silicon Valley Bank faced there. And so our continuous assessment is to see that the banks have got adequate capital buffers to withstand any rise in bond yields. And as we had seen, the bond yields could come as a result of domestic issues, but they could also come as a result of global shocks. A bit of a complex question, but I hope that that clarifies it. And Nicola and then Fundi.
On the FCI, we did not create a new FCI. Maybe that came across not as it should have. It was a revision of the FCI. So there are numerous ways in which one could compose an FCI. It all depends on how many variables and markets you want to include. And it may not all be relevant to all jurisdictions. So what works in Europe wouldn't necessarily work here. We've reviewed the components of the FCI to be, well, it has to comply to two things. You have to have regular data on it, and it has to be relevant to the funding structure in our economy. And then it's about, how much do you smooth it or not smooth it. So it's really not that it was loose and now it's tight or other way around. It's more about how, and we tested it backwards to see whether it fits what we know with hindsight to have been tight conditions or loose conditions. If you really want more information about that, it is on the website, the old one compared with the new one and what exactly has changed. And Harku, sitting there in the middle with a blue tie, he's heading the division who's doing that work. So if you want to talk to him afterwards, you're most welcome.
I told you they'll go delegate higher and higher. Fundi.
Okay. Azar, on access to finance for SMEs. So our responsibility as a South African Reserve Bank is to ensure that deposits are safe. That is our primary mandate, and that is the reason why we license. So when we put the rules in place, the rules are there to safeguard those deposits, that when they are required, they are available on demand. Then you bring up this issue around access to finance, which is a lending issue. And the lending elements, what we have found is that actually it is not us and our rules that can assist on the side of lending, because it is a risk that is taken by the entity that is providing the funds. We have found that competition has actually been the mechanism through which we have seen an increased access to finance. We cannot, in terms of our licensing regime and the rules that we have, say that we will have light touch so that you can lend more, because it's the financial institution that needs to be monitoring its own risk exposures and make sure that it is able to match, as the intermediary, the deposits that it's holding, safeguarding, versus the amounts that it's lending out, such that they are able to balance the two elements. And so in this regard, we have seen government in the past has had different guarantee schemes to help to assist with this risk mitigation challenge. We had Kula in the past. It's now a new entity, which is the combination of different entity. What is the new name of the new CEDA? Is it SIFTA? I'll check the name for you, Azar. And here it's very important for us to distinguish these roles as the SARB, because when you get to a point where a bank is in trouble and you have to go into resolution, you can only take one side as a supervisor of banks. You only take the side of depositors. It doesn't mean that we don't have an open framework that enables banks to follow different types of business models. But those business models that they follow have to take into account sufficient risk management. There has to be sufficient oversight in that regard. We don't dictate to banks in terms of what they have to do. We have seen in other jurisdictions different mechanisms that are put in place by having banks that are graded in different ways, and that allows more flexibility. But again, it is the banks themselves that still take the decisions around lending. We've seen in recent days that as banks are providing more SME type products, we are seeing that the other banks are coming to the party as well and readjusting, and that is the main route for us. Otherwise, we find ourselves conflicted when DG Modise gets into resolution to say, well, who were you? You said lend more, but you were protecting depositors. How were you doing these two things side by side? That's why the rules are around the safeguarding of deposits, and then we allow the market participants to come in. You can come apply for a banking license. We say these are the rules of the game, and you set your own risk appetite as a financial institution in terms of what you do. I hope that assists.
Thank you. And then Hilary and Yanni have not forgotten your questions. I was just checking, so my colleagues tell me my answers are too long. So I'm going to ask DG Kasim to answer your question on the paper on the 3% and the debt service costs and whether there was a tension between financial stability and monetary policy. You had had both departments report to you, so you're best placed to deal.
Let me just say that, firstly, this concern or monitoring the government bank nexus is an issue whether you're at a 2% inflation target or whether you're at a 4% inflation target. You want to assess, are there potential risks from government owning too much of the sovereign? Should there be risk weights? And that's an international debate. I think we're less concerned about it. So that's an issue in its own right. The second issue is that I think that the inflation targeting paper is a paper that makes the case for why we think a lower target has a more better welfare outcome for this economy, whether it's in the real economy, whether it's about growth. And another consequence of that is that it has a better outcome for the cost of borrowing, whether it's at the household level or whether at the sovereign level. Now, it is not prescriptive about government's debt strategy. It says that, you know, when inflation is lower or your yield curve is less steeper, it allows government to be able to kind of issue the more shorter end of the maturity spectrum when you have inflation, but more importantly, interest rates are lower. So it's really, I mean, it happened with government when actually inflation was lower during the COVID period. So in some ways, they're kind of unrelated. What you're trying to understand is the risks to inflation or risk to the banks owning debt. At another level, I think that the government's debt issuance is really a function of what they confront, be it inflation, be it the risk premium, and so on. Now, Azar's question that if the yield curve is very steep, the incentive is to kind of issue, buy more debt at that level and lend less, is a difficult question to answer because it kind of raises this question. Are they lending less because they want to earn a better income from the steep yield curve, or are they lending less because there's just no demand in the economy for that? But it is the case that a lower and a flatter yield curve means that the risk of interest rate risk for any holders of bonds is mitigated. So they're complex. Ultimately, you can find the links, but in some ways, there are kind of two separate issues. Thank you.
If I can just, I've now found the information as it's now called the Small Enterprise Development and Finance Agency, which has combined a number of different institutions, right? So it still has got the old function that was providing credit guarantee and credit enhancements, and also elements of retail finance. So it's got financial support and non-financial support for SMEs, which tends to be the issue that when SMEs arrive at a bank, they don't necessarily know how to best compile information to enable them to make applications. That's where the non-financial support comes in. But for some of them, you do need financial support just to augment the interest differential between what the bank is asking for and then where government can come in to assist. Thank you.
Thank you. Just to close that one off, there might be a difference in calculation of how much debt service costs would be saved with a lower target. What is not in this agreement is that debt service costs will be lower with a lower target. It's just simple arithmetic. Let's start with the inflation-linked bonds. Government has just over 400 billion rand worth of inflation-linked bonds. Those bonds, their debt service costs are reset based on the inflation rate. If the inflation rate is lower, they are reset lower. It's just very simple. Government just saves straight away from that one. Without talking about changing whether you are issuing short-term or long-term, that is it. You can issue more long-term or short-term inflation-linked bonds, you will benefit from a lower inflation target. That's just straightforward. I spent time trying to explain the different components of a government bond yield. And I always say, as a point of departure, unless you are a very irrational investor, there is no rational investor who will accept a government bond yield that is lower than the inflation rate. They would not. In addition to that, they would say, well, this government, in the past, they surprised us. They said inflation will be 4.5%, and it came out at 7.8. Can't trust them. I want a cushion. And that compensation we call the inflation risk premium. And so investors would want to be compensated for that. And then if they borrow longer, they lend to you longer, they would want to be compensated from the fact that you are keeping my money a little bit longer, will you be around to repay and so forth, or would things change and the Lord? And lastly, well, I could go and buy risk-free assets. And if I don't buy risk-free assets, I have to buy your assets, you better add some spread. And that is going to be the country risk premium. So, the two components that authorities, fiscal and monetary authorities, have got control of, but particularly and especially for the monetary authorities, what we have control of is the inflation risk premium. And that inflation risk premium will come significantly lower with a lower inflation target than with a higher inflation target. The other component that has to do with the country risk premium, it does have elements of it as to whether you have got a credible central bank that will keep inflation under control over the long term. We don't have doubts about that. The next question would be, well, you said you are going to borrow this much, fiscal authorities, but you came back and said that I will borrow 1 plus X. So I can never be sure if when I buy these assets, whether this asset price would deteriorate because there are more of these assets in the market or not. And that is why fiscal dynamics play a very important role in that country risk premium. And so in then quantifying the benefits from the debt service costs, you take those dynamics into place, and depending on the assumptions you make, you might arrive at different things. But as we said, if it was inflation-linked bonds that we are issuing, I am telling you we will control this inflation. This is the target. We will achieve the target. And you investors say, oh, no. You are not going to do it. You will not be able to do it. Put the money on the table, because if you believe that I am wrong and I turn out to be wrong, you'll make a lot of money. But if I am right, then it's me who makes the money, except that is through the savings on debt service costs. And that is basically the logic. If it was nominal bond yields, again, if we had said that we are lowering the target and we achieve a lower target, that means the debt that gets reissued, new debt that is issued, will be issued at lower bond yields because the inflation risk premium has come down. It becomes more pronounced if the borrowing strategy is adjusted because you have got a steep yield curve that you then go shorter. We do not give advice on borrowing strategies. The Treasury must make those calls. You can make them short, and you can save a lot of money and flee, but you also face a refinancing risk, and that is why those decisions have got to be taken in a Treasury rather than in a central bank environment. Professor, yes, indeed, the thickness of coins had changed. Why did it change? It changed after years of engagements with a section of society, the visually impaired, which complained that they cannot distinguish from the coins, the third decimal coins. So when we moved to the fourth decimal coins, we adjusted the thickness of the coins. That they do not fit in the vending machine is interesting news for me. When we switch the coins or banknotes, we give a set to each vending machine provider to recalibrate and reset their machines to make sure that they can take both the old coins and the old coins, or both the old notes and the new notes. And of course, if you find that the coins are not particularly useful, when I grew up, my mother used to give me a piggy bank, and I used to throw them in there until the piggy bank is full. Once the piggy bank is full, we take it to the bank, they break it, and then we deposit it. The bank will still take those coins. That would be what I would say to the people. Any other questions? Danelli? Danelli is there. I don't know why she doesn't want to sit with Andrea.
Thank you, Governor. Just a quick question, a clarifying question on the credit to GDP gap, or the credit gap. Does that at all incorporate, is that purely bank credit, or does it also incorporate microfinanciers? The reason why I'm asking, there seems to be a trend building up where there's been a higher reliance on credit activity outside of the banking sector, and so maybe that's worth explaining. The second question was really about FATF. During the time when we were listed, there was quite a lot of concerns around potential capital outflows as a consequence of being on the grey list. Has the Reserve Bank perhaps done any work to justify how big those outflows might have been, and would us being removed from the list potentially crowd back in some of those flows again? Any comment on that would be appreciated. Thank you.
Thank you. Any others? Okay, let's move online.
All right, Governor, there is a question which says, can you provide a bit more information about the resolution simulation exercise? What was it about and who was involved? And one question on geopolitics, and it goes as follows: the ramp-up in tensions between Israel and Iran in recent days seems to be at the risk of escalating with the potential of US involvement. How significant will this development be for financial stability here at home? Thank you.
Okay, and last question.
Thank you very much, Governor. My name is Rufus from BIAC. We are worried that you are no more playing on 100 basis points. Now you are going down to 0.25. So we know we are black insurance planners. So we were thinking if you go back to your normal 100 basis points, you'll put more money into the hands of the consumers, and as a result, they'll buy more policies from us. So I don't know what is stopping you from playing around there, going down to 0.25, and very soon you'll be on 0.125.
Okay, thank you, Rufus. You didn't say 100 basis points in which direction? Okay, that will, we will close with those. Credit to GDP gap, you invited that on yourself, Nicola. Did you say resolution simulation? I thought I had climate thing, but the head of the resolution is here. DG Mampo, if you please, you could deal with that regulation simulation. And then, okay, I will deal with the last two.
The credit to GDP gap is indeed only bank credit. It's dependent on data availability. I mean, that is often a big constraint. There is a rise in private credit markets, not only in South Africa, but globally, and that is one of the things that the Financial Stability Board, for example, has on its work list. I've just this morning sent through a nomination to a working group on private credit markets. So it is something that's topical, something that we will monitor as much as we can, but it's private, so you don't always have the information. But the credit gap is bank credit.
Thanks, Nicola. So on page 24, we have the details of the simulation, but basically the reason why we worked with the World Bank to do the simulation was to test if both the resolution authority as well as CODI would be ready in case of a distressed bank. The simulation focused on a medium-sized bank where the strategy was a closed resolution, basically closing that bank, what is required, who needs to be consulted, and what are the timelines of consultation, and what are the parameters we had to consider. So the outcome of the simulation was that we are to some extent ready, but there are still areas where we need to improve the time it takes for us to respond. So for example, for CODI, at that time we were looking at a 20-day response period from a bank failure to the payout, and we've been working with the financial markets team and other players to shorten that timelines. The second gap that we identified was that some of the banks do not have sufficient information for depositors, and that's why in our communication in terms of CODI, we have been asking the depositors to please update their information so that in case there's a bank failure, it is easier for CODI to collect the information. So some of those gaps are what we identified, and the details would be on page 24. Thanks.
Thank you. No, but whilst you have the mic, why don't you deal with the Rufus's question? Because she talked, he says, when are you going to start cutting again by 100 basis points instead of 25 basis points?
We are at 100 basis points, collectively. Okay, on a serious note, when I was at the Treasury, I was really feeling what you are feeling. And it was because I wanted to spend more, and I felt the Reserve Bank is not doing justice to what needs to be done. But if you look at how the decision is made based on data outcomes, it's based on the models that we have, it's based on the assessment of risk. And what I've learned now is that monetary policy has to be predictable. You can't have a policy that is unpredictable and creates uncertainty in the system. So the manner in which we make our decision, of course, based on information, based on predictability, based on the risks that are there that we assess, we have to make sure it is predictable and we're moving cautiously because there's still a lot of uncertainties that we are faced, whether you're looking at globally and you're looking at domestic. Those uncertainties make it a bit difficult for us to move quickly. So for example, budget 2.0, we had VAT, we had other components of the budget that are no longer there in budget 3. Because of those uncertainties, it's a bit difficult for us to move significantly. But collectively, we are at 100 basis points.
You mean cumulatively, we have cut by 100 basis points. And actually, when we cut by a full 100 basis points, which was twice, it was in the middle of COVID. So I don't want to say, do you want the return of COVID so that you can get 100 basis points? But thanks for that question. FATF, it's a difficult one. I think that at the time we were put on grey listing, the question was asked just before we got put on, if we get put on grey listing, how much money would move out? And said, it depends on how much has been priced in. And when we were eventually put on grey listing, we didn't see a lot of money move out. There was some movement, but there wasn't a lot of money moving out, and which then lent credence to a thesis that said all the money that wanted to leave had already left. Okay? So now, as we were getting off the grey list, as we were making progress in addressing the recommendations, any smart money would have looked and said that it's time I get back into that country because I think they're going to get off the grey listing. You did see some bond inflows come in. But there are always doubting Thomases. And the doubting Thomases might now look at this as, oh, I am missing the boat, let me go back in. How much of that is in what position is a difficult thing for us to assess. And geopolitics impact on financial stability, very difficult to assess. All that we know is that potentially it could. What would be the channels that it would come through? Potentially it could come through the impact on capital flows, and with the flows and adjustments in exchange rates and financial market prices. It could also, importantly, come as a result of a shock on economic activity, and that has got consequences for the health of the borrowers and could feed into the feed negatively into the balance sheets of the financial institutions, but too early to tell. We had flagged it here because this had come in this way. And lastly, we had seen the impact on the oil price. Again, you've got to make the assessments as what is the big exposure. We are not, our financial sector is not a big trader in the oil market, so it's not something that we think will have a direct impact, but the channels are all indirect. Fafa, I cannot believe that you decided to pass the note to Nicola and not answer the question yourself, but be that as it may. Thank you very much for your attendance. That concludes the business. Thanks to the panelists and to the staff in Financial Stability Department. Once again, thank you very much for a good document. Hopefully, people read it and understand what it is that we do. And there are refreshments, I'm told, outside. Continue the interaction. Herco got delegated a question, so Andrea, if you want to take the thing further on the FCI, he is your man. Meeting adjourned.